Good afternoon, everyone. Bert Salazar here. Welcome to our webcast. Today's going to be a very short one. Today, we're going to do a webcast on how to divorce the IRS in retirement. And this, you obviously want to do it legally. So all the information that we're going to be providing you and that I'm going to be providing you here today are things that you're going to be able to do from a legal standpoint in order to reduce the amount of taxes that you pay in retirement and or eliminate the majority of taxes that you will be paying in retirement as well. Now, I'm going to give you an example of a client that actually they both, husband and wife, they both came in to see me last Wednesday, right before Thanksgiving, because they're starting to do some tax planning for 2018. They're both 65 years of age. They have been retired now for approximately 6 months. And their goal was to take primarily income coming in from their IRAs. And then because of the fact that they have been working with me for approximately 8 years now, we have done quite a bit of planning. So we created Roth IRA accounts for them, and they've been contributing money to those accounts for a number of years, both him and his wife. And by the same token, we set up a PERP, which is a personal insurance retirement program that takes into consideration the growth of cash values inside a life insurance contract, which grows on a tax-preferred, and then you can distribute that on a tax-free basis if you do it properly, along with Social Security protection benefits and so forth that I will discuss in another webcast. For your information, we also do a longer webcast, which is about approximately an hour and 15 minutes. And that one deals with how to reduce the impact of taxes in retirement. In that webinar, I go into quite a bit of details regarding tax planning as it is today, and regardless of what's going to happen in the future with tax reform in the U.S. Obviously, the Senate is about to vote on that, and no one knows what's going to happen. But at the end of the day, one of the major things that I tell my clients all the time is that they should never, ever allow anyone to dictate what their tax bracket in retirement is going to be. So in this situation for these clients, they came in to see me. They're taking money out of their IRA account, and they're also taking distribution from other sources that I have created for them over the years. They're taking income out of their Roth IRAs, and also they're taking income out of their life insurance contract. The total amount of income for the combination of the Roth IRA and the life insurance contracts that they're using as a personal insurance and retirement plan right now exceeds $40,000. So they're doing fairly well. Because the income is coming out of a Roth IRA and it's also coming out of a personal insurance and retirement plan, that income does not get factored when they're filing their income taxes in 2017 and beyond. So we're going to be discussing a technique that I shared with them last week, and they immediately fell in love with it. And this is a technique that would allow all of us to see, and all of you to see, that not all income in retirement is created equal. So I'm going to share with you what it is that they were thinking of doing and the reasons for that. And then I went ahead and gave them a different strategy altogether. And obviously, you're going to notice what the big difference is on that from a taxable standpoint. So in order to get going, and again, this is a short webinar, I'm going to go ahead and I'm going to shut down my video so you don't have to see me on the video. But then I will be back later on and we'll finish up the webinar. So with that being said, let me go ahead and shut off my video, and now the only thing you're going to be able to see is my screen and then the software program that I used for these clients last week. Now, please bear in mind that as a financial planning firm, we do a lot of insurance, risk management planning. We do pensions for our clients, and we work not only with individuals, but also we work with business owners. By the same token, we also do tax planning for them. The big difference between what we do at Cambridge and what the majority of our competitors do in the marketplace, and I'm talking about primarily accountants and CPAs and tax preparers and so forth, is that they're always looking into the rearview mirror. So for 2017, you and your family, if you're married, filing jointly, you've been working. At the end of the year, you're going to gather all your expenses. In January, you should be receiving your W-2s and 1099s. And then sometime in 2018, you're going to walk into your accountant's office and you're going to provide them with the information that you gathered. Now, at the end of the day, the accountant is going to take a look at that information. They're going to try to make certain that you pay the least amount of taxes for 2017, but that's pretty much it. They don't have the ability to do any type of tax forwarding planning as what we do here at Cambridge. So we have the ability not only to look in the rearview mirror, but we also have the ability to look not only for 2018, but also 2019, 2020, and beyond. Our goal is to make certain that we can eliminate the IRS in retirement. And sometimes we have the ability to do it on 100%. Other times we have the ability to do it on a 95%, 90%. But at the end of the day, if you follow the techniques that we're going to share with you today in this webcast, you're going to be able to maximize your income in retirement, and you're going to be able to get rid of the tax liability, which is one of the major eroding factors when it comes to retirement distribution planning. As you can see there in your screen, these clients came into my office. Now remember, they have additional income coming in from Roth IRAs and personal insurance and retirement plan that will not factor into their tax planning calculations because the income from those vehicles are totally tax-free in retirement. So these clients are now generating $50,000 of additional income. And what they were doing is they were pulling this money out from their personal retirement accounts, personal IRAs. There was a little bit of money coming in from a pension as well. Now, please bear in mind that whenever you put money into a 401k or an IRA, or if you happen to be a public employee and you're putting money away in either a deferred compensation program or a 403b, the money that you put in goes in on a pre-tax basis. So if you were earning $80,000 and you put $5,000 away into your IRA, you only pay taxes on the $75,000. Now, that $5,000 that you put away into the IRA will now grow tax deferred. And then at time of retirement, when you start pulling out that money, you then have to pay taxes not only on your contributions, but also on the growth of that money dollar for dollar. So in reality, when I hear clients telling me, and many times professionals telling me that clients have the ability to avoid taxation by putting money away in qualified plans, that's a totally untrue statement, because the assets inside those plans are deferred, but they're not tax-free. So at some point in time, you're going to have to pay taxes. So the question to many of my clients is, well, if you own a wheat farm, would you rather pay taxes on the seeds or would you rather pay taxes on the harvest? Now, depending on your tax situation, the majority of the time you're better off paying taxes on the seeds than paying taxes on the harvest. So in this scenario, as you can see in front of you, these clients are generating $50,000 again of IRA income. And if you notice that between $0 on the bottom left-hand corner to approximately $23,250, The first $23,250 that the clients generated in income paid zero in federal income taxes. And the reason for that is very simple. You have deductions, you have exemptions, and you have credits that are allowed under the IRS code. And now, obviously, with the tax reform that is being talked about in Congress today, they may be raising those numbers, but we're just going to stick to what it is today. So the first $23,250 that this family generated or took out off their IRA account, they did not have to pay taxes on that money because of the deductions, exemptions, and credits. Then from that money forward, from $23,250 all the way to $41,750, the clients paid a 10% tax on that because now those monies entered into the 10% tax bracket. Now, currently we have 7 tax brackets in our tax code. We're not going to get into each and every one of them, but we have the 10%, we have the 15%, and then obviously the 25% and so forth. But because of the fact that we're only looking at $50,000 of taxable income for those clients, now we know that between $23,250 and $41,750, the clients paid a 10% tax liability. And then from $41,750 to the $50,000, that was the amount that the clients generated, that the marginal tax bracket for that level was 15%. Now, please bear in mind that there's a difference between the marginal tax bracket and the effective tax bracket. So if you look here on the bottom, you notice a total income of $50,000, and the total tax is $3,076. Now you would ask, well, Bert, how can it be $3,076 when the $50,000, the last dollar on that $50,000 was taxed at 15%? And the reason is that that is the effective tax rate. So in reality, the clients paid $3,076 in federal income taxes, and that amounted to an effective tax rate to the right of 6.15%. Not too bad, not too bad at all. Now the question is, well, can we do better? And the clients obviously were looking for different options. Now, one of the things that the clients had told me is that they were not interested in taking Social Security benefits at this point in time because they wanted to grow their Social Security benefit to later years in order to generate a higher Social Security distribution. One of the fallacies that we deal with when it comes to Social Security distribution is we have to make certain that the clients are not just delaying the Social Security distribution for the sake of it, that they're doing it through economic purposes, that they're doing it through economic models, because many a times it might very well make more sense to start taking distribution from Social Security earlier than you would by delaying those Social Security benefits. So one of the exercises I did with these clients is I went ahead and created a different scenario altogether. So in this scenario, what I did for these clients, as you will see in a minute, I said, look, what if you don't have to take the $50,000 out of the IRA and generate that $3,076 of tax? All of the clients, were okay with the 6.15% of effective rate. The question that I asked for them is, what would be the best tax bracket for the two of you in retirement? And they couldn't answer that. And then my answer to that was 0. So if I could get them as clients to have an effective 0% tax bracket, then I have done my job as an advisor and also as a tax planner from a business perspective. So I went ahead and did the following exercise. I took I went ahead and added the $35,000, which was the combined Social Security benefit that they would have received had they applied for Social Security today. and then try to mitigate those $50,000 of income. Because at this point in time, these clients just needed the $50,000 that was coming in today, plus the additional money that was coming in from the Roth IRA and the personal insurance and retirement plan that was not taxable. So based on that scenario, the $50,000 that they were generating by taking distribution from their IRA account was more than enough to maintain their standard of living. So the exercise that I went through with them, I just went ahead and changed the numbers in order to get them to see something quite interesting that many of our clients don't have the ability, and many Americans don't have the ability to plan forth because of the fact that they're not dealing with advisors that understand tax planning and use tax planning software the way that we do. So in this scenario, the client was able to generate $35,000 in Social Security benefits. And then I went ahead and added another $15,000 to make up the difference between $50,000 and $35,000. So notice on the bottom right-hand corner that in the green scenario, that was the first scenario that I shared with you a couple of minutes ago, the clients were generating $50,000 of income. They had a total tax of $3,076 and an effective tax rate of 6.15%. But just by shifting the income distribution to include Social Security benefit and reducing the amount of income that they're pulling out of their IRA distributions, we were able to again create the same $50,000 of income that they needed, except that the total tax for this exercise and this technique was zero. And again, the effective rate was zero. Now you wonder, how can you do that? Well, you have to do proper planning in order to do that. So in this scenario, think of it this way. Most IRA distributions are taxable. Why? Because you put money in on a pre-tax basis. The money grows tax deferred, but then when you pull it out, you have to pay taxes. Well, what if you can have your cake and eat it as well? What if you have the ability to put money into an IRA account, have the money grow on a pre-tax basis, and then pull the money out tax-free? So you didn't pay taxes on the contribution, you didn't pay taxes on the growth of that investment, and most important, you avoided taxes on distribution. That is what we consider to be a win-win-win scenario for the clients. Now, the next question I ask the clients is, well, do you need any additional income? And the clients say, well, Bert, at this point in time, we really don't need any additional income. And I said, well, if that's the case, you know, what if we were able to pull more income out of the IRA? Up until what level could we continue to pull income under this technique from the IRA without having to trigger a tax liability? So I started to go up by $1,000 marks. So we went to $16,000. Notice, still no tax liability. We went to $17,000, no tax liability. We went to $18,000, no tax liability either. $19,000 the same, $20,000 the same. So now the clients would have the ability to pull an extra $5,000 out of their IRA and have an effective tax rate of 0%. Now you wonder again, you know, well, what if the clients do not need that money? What can they use that money for? Well, one of the things that the clients can do under current tax law is that they can take that additional $5,000 and convert that $5,000 of IRA distribution to a Roth. And if they do that, the only issue there is that they would have had to pay the tax liability on that conversion under the first scenario. But under the scenario that I put together for the client, they have the ability to convert that to a Roth IRA, which now will allow that money to continue to grow for many, many years to come on a tax-free basis. But because of the technique that we're using today, they didn't even have to pay taxes on that $5,000 conversion. Now, one of the major differences between traditional IRAs and Roth IRAs is that at age 70 and a half, if you happen to be in a traditional IRA, you need to start taking minimum distributions whether you want to or not. If you happen to be in a Roth IRA, you're not obligated to take distributions out of the Roth IRA at age 70 and a half, so you can allow that money to continue to grow tax-free for many years down the line until such time that you feel the necessity to invade your Roth IRA contributions. So in this scenario, the clients had never thought of it this way. The clients felt that if they needed some additional income, they would have to maybe liquidate some of their current mutual funds, but that would have created a tax liability. So this exercise gave them the opportunity to pull away another $5,000 without having to pay any taxes whatsoever. So the next question I asked for the client is, well, how do you feel today about the $3,076 that you would have had to pay, or that 6.15% that you would have had to pay had you not come to see me from a business standpoint? And the clients basically say, you know, Bert, if I was able to pull $50,000 and only pay $3,076 of taxes on that money, plus we have our Roth IRA and our personal insurance and retirement plan coming into us on a tax-free basis, that would have been a gift for us, and we would not have had any issues at all in order to pay that money. So that my answer, or my rhetorical question to them is, well, how much more could we pull out of this IRA account now that will, because if I go to another $1,000, so now at $21,000, now I start to have a little tax liability there, you see, of $96. So if we want to emulate the $3,076 of taxes that the clients were willing to pay, how much more could we pull out of that IRA and then convert to a Roth to create a completely tax-free retirement system for our clients? So in this scenario, we continue to go up, and my goal is, you see now I can pull $25,000 and my tax liability is $698. So I was able to pull another $10,000 on behalf of the client for a minimum cost of just shy of $700. I want to keep going and see how far and how much money we can actually take from this IRA without having to go above the number of $3,076. Let me go one more $1,000. Okay, we now just went over by $8. So think of it this way. The client was able to pull $15,000 up to $20,000 and pay no taxes whatsoever. And then we continue to take distributions up to $36,000 of additional IRA. Remember, the client only needed $50,000 of income. So now they have the $35,000 coming in from Social Security and the $15,000 from their IRA distribution for a total of $50,000 of income. But then we were able to pull an additional $21,000 of income for a basic effective tax rate of 4.34%, which is even lower than the effective rate of 6.15%. And the client now has a total of $71,000 of income instead of $50,000. Obviously, because of the fact that the client does not need that additional $21,000, we're now able to convert that $21,000 to a Roth IRA and have that conversion continue to grow for many years to come on behalf of our clients on a tax-free basis. I think the exercise here And the point that we're trying to make and that I'm trying to make to all of you is that our number one goal is to get our clients and our friends, to change the way they see things. Because when people change the way they see things, the things that they see change. And in this scenario, these clients have the ability to pull a lot more income, be able to convert that income to a tax-free account for the rest of their lives, and one that is going to liberate them from having to start taking distributions at age 70 and a half. And if we continue to do these techniques for the next 5 years, we can shelter a tremendous amount of income that by the time the client gets to that minimum distribution requirement, obviously what they're already taking will more than suffice from a business and from a tax planning perspective. Again, this is the type of work that we do here at Cambridge. That's why I felt that it would be very, very important for all of you to see this tax-aware performance. And by the way, the other thing that we do is we have a customized retirement blueprint that we have available for all of you. Now, for many of you, you may want to try to do this yourself. You're going to have to do some net present value calculations that we specialize in doing here, or you feel free to reach out to a tax advisor that you deal with. But what you will find is that the majority of advisors in the marketplace do not specialize in retirement distribution planning as we do here at Cambridge and as we do in my firm. Now, if you wish to engage our services, we would be more than happy to help you along those lines and to provide not only the tax planning blueprint for your individual situation, so it would be customized for each and every one of you, but most important, we're going to be able to assist you by identifying the critical products and services that you are going to need in order to maximize this technique to the fullest. So with that being said, I don't want to take any more of your time. I appreciate you joining us. And at this point in time, I'm going to just shut down this webinar, and we're going to